So now to question 4. So question 4 here says, a bank reconciliation statement is a statement prepared by a current account holder for the purpose of finding the difference between the bank balance and the cash book balance and harmonizing the figures in the bank statement with those of the cash book. So you are required to identify the entries that appear in the bank statement but not in the cash book. So first of all, you need to understand what a bank statement is and what of course we've talked about what a cash book is in the previous questions. But what does a bank statement talk about? A bank statement is the record on the part of the bank of all the transactions of a business. So a bank statement shows all your transactions in their own accounts. So now the question is saying that you should identify entries, that is transactions that appears in the book of the bank that may not appear in the cash book. So those are the things that you are asked. So for exam purpose, if you are asked this kind of questions, they are very straightforward and simple. So number one thing that can show in the bank book that will not appear in the cash book, that is our own book now, is number 1, standing order. Standing order. What does a standing order mean? A standing order can be, for example, you have told the bank to, at a particular date, pay a particular sum of money to a customer or to somebody. Say for instance, okay, you have informed your bank, written a letter to them that on the 28th of every month or on the 25th of every month, pay the sum of 5,000 naira to Mr. Bankole. So the bank does not need to consult you anymore because you have given them a standing order. So the bank of necessity just does what you have asked them to do at that date. So standing order. So it will appear in their own book but might not appear in your own book because you might have even forgotten that, oh, I told the bank to withdraw or to deduct from my account at this so date this so amount of money. So it appears in the bank statement but might not appear in your own cash book because it was not deducted from the cash in your hand. So number 1 is standing order. Another one is bank charges. Bank charges. So bank charges is another entry or another transaction that can appear in the bank statement but not in your cash book. Bank charges are deducted by the bank on transactions or from current account holders or anyone. Bank deducts this amount even without your own knowledge or your own consent. So it appears in their own books but might not appear in your cash book because you don't even know how much the bank will deduct as bank charges, maybe on a transaction or at the end of the month. So many transactions that happen in an organization or in a business. So those transactions, you don't even know the one bank would deduct money from or the one they would deduct at the end of the month. So bank charges, it will appear in the bank statement but you might not be aware of it, which will make it not appear in your cash book. Another one is dishonored check. Dishonored check. So a check that has been dishonored by the bank, you will not know. Say for instance, you want to make payments for a particular thing and you issued out a check from your organization or from your business to a person to go and get the cash or get the payment from the bank. Then the bank dishonors the check for any reason. There are so many reasons why a check can be dishonored by the bank. If the check is dishonored by the bank, it will only be known by the bank and you may not even know that the check has been dishonored. So it is an entry that will be in the bank statement but will not appear in your own cash book because it is outside of your knowledge. So dishonored checks will not appear in the cash book until you are being notified by the bank or until you get your bank statement. You might not know or you might not have identified that there was a dishonored check. Another one is dividend paid directly to bank. dividend paid directly to the bank. So this is another one. So sometimes you get dividend maybe from your investments in other organizations, and then they pay it directly without even your consent to the bank that you gave them to pay to. So when such transactions happen, they might be outside of your knowledge and you will not record them in your cash book. But to you, they are an income, and the bank, of course, debits you or credits your account, but you will not be informed. Maybe until you get your bank statement is when you would see that there was a dividend paid directly into your bank. So this can also be an entry that would appear in the bank statement without your knowledge, so you will not record it in your cash book. And for exam's sake, you can also write direct debit, direct credit. So when your account is credited directly, maybe by somebody that you were not informed, credited to the bank, but you were not informed, or say maybe a gift or anything to the business, it will not be recorded in your cash book, but the bank statement will reflect on your bank statement. So this can also be an entry that appears in the bank statement but not in the cash book. So for example, if you have these 5, you are good to go. Then 4b says, what are the entries also that appear in the cash book but not in the bank statement? What does this mean? So there are also some transactions that you have directly transacted, but the bank is unaware of it. So it will not appear in the bank's book, but it will appear in your book. So it can cause a discrepancy or a difference in the statement, in the balance in your cash book, that is the bank side of your cash book, and the bank statement. And originally or normally the bank side of your cash book should be equivalent or should be equal to the bank balance on your bank statement. So this is what they are asking here, that what are such entries that you might have recorded in your cash book that is outside the knowledge of your bank, so they did not record it in your bank statement. So number 1, if you are asked for this kind of question, the number 1 thing is unpresented checks. Unpresented checks. So a check that you have, for instance, you are working on a June cash book, and when you were recording your cash book, you gave a check of say 20,000 naira to somebody for payment for a particular thing. Then when, as at June 30, okay, maybe you issued the check on the 29th of June 29, but as at maybe the person did not go to the bank until July 2nd, and you are preparing your accounts as at June 30, which is the end of the month. So the person has not presented the check to the bank, but in your own cash book you have written that, oh, I have paid this person 20,000 naira by check, because you have written it on your bank, but in the bank side of your cash book, that I have paid this person 20,000 naira from my bank, but the person has not even visited the bank to present the check. So it appears in your own cash book that you have paid somebody 20,000 naira, and the bank is here to see the person to get the money from them. So unpresented check can appear in your cash book at a particular time and might not appear in your bank statement. So it can cause a difference in your bank balance and the cash book. The next one would be uncredited checks. Is similar to this. So checks that have been credited by the bank, but you are not you have credited it in your books, but the bank is yet to acknowledge it, or the bank has not yet credited the person. So say for instance, like we used on June 30, you issued a check to somebody and the bank has received it, but the person has not been credited. they've not credited the account of the person that you asked them to. So in this case, it can also be, it will appear in your cash book as a payment, but the bank is yet to pay it, so they will not record it, so it will not appear in the bank statement. So for this question, you were asked to mention, identify entries that appear. So part of these are essentially what you have. You don't have so many things that appear in your cash book because it is your own book, so you have majority of the transactions, but the bank is not the one running the business, so you have very limited things that appear in your cash book and does not appear in the bank statement. So for question 4C, you were asked to prepare an adjusted cash book and draw up a bank reconciliation statement as at June 30th. So the question says the cash book of High Rate Limited had a debt or debit balance of 760 naira as at June 2019, but this was not the same of the bank statement at the same date. An investigation into the differences yielded the following information. So all you just need to pay attention to is the details of the information that were given to you. Majority of these differences are what we've highlighted in 4A and 4B, but you just need to know what the differences are so that you can know where to make the adjustment. So we have to do an adjusted cash book. We are working on High Rate Limited. High Rate Limited. So the first one says that we have a debit entry or a debit balance in our cash book. So balance as per cash book. So they're giving us as 760 naira. So the first one says a cash paid for public relation on 2nd of June 2019 for 358 naira had been entered in the cash book as 385. So here they told us that a check that was paid for public relation on 2nd June was 358 naira. So we issued out a check of 358 naira, but we made an error in recording our books. In our books, we recorded it as 385 naira. So there is a difference in this. Of course, maybe human error or anything. So there's a difference of 27 naira. So the error was committed on the credit side, and it has to be adjusted the same way on the credit side, that we had a payment of 358 naira that was recorded as 387. So to remove the money now is going to be recorded on the credit side as payment overcast of 27 naira. So now they told us that we have a standing order for a charitable subscription of 80 naira. So I told us that standing orders have been given. Maybe for instance, you gave your bank, okay, at so date, pay this certain amount to this person. So this organization or this entity has given a standing order to the bank to pay this amount to that charitable organization or a charitable subscription of 80 naira. But in their own books, they did not record it. But because they've given the bank an order to do so at that particular time of the month, the bank had already carried out the transaction. So now, because money is leaving us, and whenever we have, like we said, debits, the receiver, and credits, the giver. So in this case, we are the giver. So when we are the giver, because the money is leaving the business and is leaving through the bank, because the bank has recorded it, and it has to come into our own cash book also as an expense because we are giving out. So we are now going to record it on the credit side as standing order of 80 naira. So what we were supposed to do, but we did not have the knowledge of it, is what we are carrying out now. Only the bank knew that they had paid 80 naira. So now when we now realize that, oh, there is a difference between our bank statements and the bank balance on our cash book, this difference is one of the differences. So we have to now credit ourselves because we did not know. So this would have made our bank balance in the cash book to increase by 80 naira because we did not deduct it in our cash book and the bank has deducted it. So now we will be deducting it by crediting it on the credit side of the adjusted cash book. So the next one says check of 3,360 naira received from customers were paid into the bank on June 30, but this was not reflected on the bank statement. So we had a payment of 3,360 naira to us and the person paid by check. So in our books we believe that the person has made payment, so we would have recorded this in the original cash book as a debit entry of 3,360 because we believe the person has paid, but we did not take the check to bank until another day, which was after the month. So we have not recorded it, the bank has not seen it, but we have seen it that okay, the person has paid. So we know we stated it the other time that it's part of the entries that can come into our cash book without the knowledge of the bank. So what are we going to do to this? The bank has to record it in their own. So it will not come to the cash book, it will go to the bank reconciliation statement as an addition because it is not an error that occurred by us but by the bank. So it will be added to whatever bank has in its bank statement. So that will be omitted till we get to the bank statement. The next one says on 28th June, a check of 228 naira was received from a customer. So we received money in settlement of an invoice for 240 naira. An entry was made in the cash book. So in the cash book, they told us that the check has already been received and we have recorded it in the cash book as 240, and we received a check of 228 for something that was 240 naira. So it means there was an undercast of 12 naira. So the person paid 228. We received a check of 228. And what we have in the invoice was 240 naira invoice. So it means it was supposed to pay 240 naira, but in the check. So what could have been responsible for this? And they didn't tell us. It means probably it was given a discount of 12 naira. We are going to write it as an undercast of 12 naira in our books. We are going to expense it, so 12 naira in our books. The next one says a check for 2,074 naira sent to payable, that is sent to somebody we are owing, on 30th June. We are not paid by the bank until 6th July. So it's just an example of what we did earlier. So we paid somebody by check on the 30th of June. We paid them 2,000, June 30. We paid them 2,074 naira. But this person did not take the check to bank until 6th of July. So it means the bank have not seen it. The bank would have not paid the person, but we have recorded in our books that we have paid the person. So it's the bank's error. It's an error that was committed, so it has to be recorded in the bank as an unpresented check. It has not been presented to the bank as at the date we were preparing this cash book. So it will be recorded in the bank reconciliation statement. Then they said check of 504 naira lodged in by iWade Limited, who maintain an account with the same bank, was credited wrongly by the bank to the account of iRate. So it's like I explained earlier. So there's a company that is named iWade, and our own business is called iRate. So the bank committed an error by making a particular payment or lodging a check wrongly into the account of I-Wade 504. So they received money that was not theirs. So it was the error committed by the bank. So because we did not see it, we are going to record it on the debit side as bank error of 504. So because the bank will correct the error, and when they correct the error, they would have to debit us. So when they debit us, it means the money is coming in and we debit ourselves whenever we are the receiver. That is why this 504 is coming to the debit side. So they said the bank statement showed an overdrawn balance of. So now that's all for this. So the last one says an overdrawn balance. It means we are owing the bank at the end of the month of 87 naira. That's what their own balance is showing. So we can balance this account. So here we have 27 plus 80 plus 12, 27 naira plus 80 naira plus 12 naira. That is 119. We have 119. And for this side, we have 760 plus 504. We have 1,264. 1,264. So we remove the balance of this 119 from 1,264 minus 119, 1,001. So the balance here as balance carried down will be 1,145. So that is 1,264. So that will be the balance. And this is your adjusted cash book. So for the bank reconciliation statement, because we have had so we are still working on High Rate Limited. So we are working on the bank reconciliation statement. So we are working on the bank reconciliation statement. So the bank reconciliation statement as at June. So because they've already told us that the bank, because this is like an account of the bank, so they've already told us that the bank statement showed an overdrawn balance of 87 naira. So it has to be overdraft as per bank statement. So because it is an overdraft, it means we are lessing it. An overdraft means you are owing. So when you are owing, it has to be in jackets like this. So because we have uncredited checks, you had it. It has a format. So the format is what we are following. You had unpresented checks, you had it. Or let's use add unpresented checks. So we already identified an uncredited check of 3,360. So you had it. 3,360. So we have 3,273. And you less unpresented checks, which we have already identified. We identified a check that was unpresented, and that is number four. Number 5, a check of 2,074 to payable was yet to be presented. 2,074. So you deduct it 3273 minus 2074. We have 1199. 1199. So this is your balance as per bank reconciliation statement. So this is all about the question. This has a format already, and because you were given an overdraft, if you were not given an overdraft, you bring down your balance from the adjusted cash book as balance as per adjusted cash book. You add your uncredited checks and you deduct your unpresented check. So number 5. The number 5 question says you should write briefly on the following. All of these concepts are not new to you, and they are concepts in accounting that anyone who is studying accounting or a student of accounting should be familiar with. So trading accounts in this case is the number 1, and it carries about. So for accounting questions, when you are asked to write brief notes or brief information, to give brief information about any concepts, they don't need 10 lines, 5 lines. All they need from you are certain keywords in definition. When you write those keywords, you are fine. You will get your full mark. And in this case, it is just 2.5 marks per question or per concept you are asked to identify. So trading accounts, I said, it is a financial statement that shows the gross profit or loss. So it is a financial statement, or let's say this, that it shows the gross profit or loss. You know what? If you write this in your exam, you are halfway done, because the whole essence of a trading account in a financial statement is that it shows whether you have a gross profit or you have a gross loss. And what do we mean by gross profit? Gross profit is profit before you deduct your expenses, gross, before your expenses are deducted. So you have gross profit or gross loss. That is the whole essence of the trading account. So if you are able to write this, if you know this and you write it, you are halfway done. So you can just tell them that it is part of a financial statement, and it shows the gross loss or gross profit of a business or an entity. That's all. The major thing it wants to see, because what it shows, you have your opening stock, add purchases, add carriage inward, less returns outward, less the returns, you have the cost of goods sold, then you less it from your sales. All of these things are to an eventual end of deriving your gross profit or your gross loss. So if you tell them simply that the trading account is a part of the financial statement that shows the gross profit or the gross loss of a business entity, that's all, you are fine. So it is prepared as part of the final account. It is one of the final accounts. So now they call it the statement of profit or loss. But before you get your profit or loss, you have to derive your gross profit. Then from your gross profit, you less your expenses. That is what gives you the total profit of a business. So that's basically what the trading account. And if you can write this in your exams, you are fine. So the next one is carriage inward. You are asked to briefly discuss what carriage inward means. Just as the name implies, they are expenses that you incur on bringing in goods. So it's part of, whether goods or raw materials, they are part of the expenses that you incur in making sure that the entity runs. For instance, you are a production company and you make use of rubber. So the part of the cost of shipping in rubber or bringing in rubber for production, you make tires and you need rubber. The part of the cost of production in bringing in rubber will be carried inward. So it can simply be referred to as the transportation cost incurred by a business to bring purchased goods or raw materials to the business or to the premises. So you can say that it is the transportation cost incurred. Transportation cost incurred to bring by the business to bring in goods or raw materials. So this is simply the definition of the carriage inward. So the next one you have to discuss briefly is sales discount. And what do you refer to as sales? Just like the name implies, sales and discount. So there are discounts offered to customers. It can be for two different reasons. Number one, it can be to induce early payment, or it can also be to induce bulk purchase. For instance, we sell something for 500 naira each or per, or let's say we sell exercise books, and we sell for 500 naira per book. But the person wants to buy 12, so it means the person is supposed to pay 500 times 12, which will amount to 6,000 naira. But because the person is buying 12, we can reduce the price for the person. Number one, to induce bulk purchase because he is buying in bulk, and number two, because he is making instant payment. So we can say, okay, if you are going to buy 12, you can pay 5,500 naira. So that's, and the difference of 500 naira is what is referred to as sales discount. So that's a sales discount. So it helps the cash flow of the company and it improves sales when you give sales discount. So it can be written as it is, or say the reduction in selling price by a business to induce instant or bulk purchase. So when the person is buying large quantity, or when the person is paying immediately, nothing on credit, it can be offered to such a person, sales discount. So the next one you have to talk about is matching concept. So as we matching concept, that's the number 4, matching concept. So it's a very essential concept in accounting, and the matching concept says that revenue are attached to the period in which they are earned. So it says that an account is an accounting principle that ensures revenue and related expenses are recorded in the same accounting period in which they are incurred or earned. So matching concept is saying that it's just in line with the period of in line with the concept of periodicity, that when you have revenue and expenses, that's why in accounts you have balance sheet as balance as statement of financial position as at Kinicom, as at 2005, as at 2000. So you have all of that. So it's saying that revenue that occur at that time should be recorded or should be attached, or revenue and expenses that are earned or incurred at that time should also be matched with the expenses of that time or the income of that time. So if you make money if you make a certain amount in 2006, you should not record it in 2008. That's what, or 2007. That's what they are saying. That's what matching concept. So revenue and expenses of a particular period should be measured or should be recorded at the time they are incurred. Okay, if you have a transaction, say for instance, you have a transaction of in 2005 of 1 million, and that person did not make payment until 2006, but the transaction was done at this time, 2006, but the person did not make payment of that 1 million naira until 2007. So matching concept is saying you don't match because you strike the deal or because you made the transaction at this time. It's saying that don't record it at this time, you record it at the time the revenue was made. The same thing with expenses. For instance, rent. If you paid rent of 2025 in 2024, you are not going to record because you paid it in advance. You will not record the 2025 rent that you paid in 2024. In 2024, you must record it as an expense in 2025. That's what. So you match the expenses to the year or to the time that it was actually incurred, and revenue to the time that it was actually received or earned. That's what this concept is saying. Matching concepts. So you can put it in your own words, and you can also say that it is an accounting principle that ensure that revenue and expenditure, it is an accounting principle that explains that revenue or expenses are recorded in the same period that they were earned or incurred. So it's very simple. Just know that matching principle is you match revenue or expenses to the time in which they were actually meant for. So like the example of rent I used, rent, if you pay 2025 rent in 2024, you must record that rent in 2025, not 2024. It can be recorded in 2024 as an advance payment, but it must also be recorded in 2025 because that is the year you actually incurred that expenses. That is the year you actually made use of that money, because 2025 was the year the money was paid for, not 2024. So the next thing is liabilities. The next one we have to talk about is liabilities. Liability. Liability. That is number 5. Liabilities. Okay. Liabilities are financial obligations or debts that a company or individual owes to an external party. So for example purpose, if you can just write that they are financial obligations that a company owes, or that a company owes to an external person. So So if you can just, so some of the things that are important, keywords that are important that they must see is that it is a financial obligation, because you are required to pay that amount, and then it is owing. It is not an income. So there are different kinds of liabilities: non-current liabilities, or long-term liabilities, and short-term liabilities. So it can be part of your explanations also: non-current liabilities and current liabilities that are short-term in nature. Then the last one is capital expenditure. Capital expenditure. So capital expenditure, just like the name implies, they are money or funds that you spend to improve the business. They are capital in nature. For instance, money that is used to construct a building is capital in nature. And why do you want to construct a building? For instance, you are a production company and then you want to expand business. So this kind of money that you use to construct a building for the purpose of the business is called capital expenditure. So if you refer this, so if you say they are referred to as expenditure or funds spent by a company in upgrading or acquiring or maintaining or improving, any of these words that you use, in acquiring, in maintaining, in enlarging or expanding the business, maybe to acquire property, maybe to acquire land or anything for the sake of the business, is called capital expenditure. So there are many examples: purchase of machinery, purchase of or construction of new facility, upgrading of technology. All of these are capital expenditures. So if you can write these examples and then explain that they are expenditures, and they are usually long-term expenditure that maybe you pay in a long time, or they are large sum of money. So if you can just explain like that, you have your full mark in the exam. So that's all about question 5. Question 6 here says, define the term depreciation. That's 6A. So 6A says define depreciation. And to explain this is very simple. Depreciation simply means the loss in value or the gradual loss in value of an asset, not at once. So if you buy a motor vehicle, depreciation is saying in accounting that it is the gradual loss. So the car is not going to totally depreciate at once. So we have so many reasons for depreciation, so many causes of depreciation and types of depreciation, like wear and tear and so many others. So depreciation, if you can write, so like I said, you don't need long definitions, you don't need 5 lines. All you need is the keywords. Depreciation is the gradual loss in value of an asset. This is the gradual loss in value of an asset. So it is usually calculated in accounts on non-current assets. So, and we are saying an asset, we know assets are divided into so many. We have different types of assets. We have non-current assets or fixed assets, and we have current assets. So fixed assets, so depreciation is usually calculated, it is calculated on non-current assets, and it is always expensed in your statement of profit or loss account. So that's the definition of depreciation, the gradual loss in value of an asset. So 6B says Adex Nigeria Limited purchased a plant machinery for 750,000 naira. The plant machinery has an estimated life of 5 years, and the residual value is 50,000 naira. They said you are required to calculate the depreciation and accumulated depreciation reflecting each year net book value for each accounting period using the straight line method. So the formula for calculating depreciation using straight line method is depreciation using straight line method is what? Costs minus scrap value. This scrap value can also be called residual value divided by estimated useful life or useful life. Estimated useful life. So this is the formula. So they ask you to calculate for 5 years the depreciation on that plant machinery. So you can easily, and they ask you to also show the net book value for every year. So you can, first of all, you can calculate what will be the depreciation for every year. So to calculate the depreciation on this asset, yearly depreciation now, it will be, they've given us the cost, which is 750,000 naira. They've given us the cost as 750,000 naira. So we are using this formula minus, they've given us the scrap value also, that's the residual value, as 50,000 naira, and then divided by this, what is the estimated useful life? They've given us as 5 years. So if you do your calculation, you should get 140,000 naira. So it means every year this plant machinery will be depreciated at 140,000 naira. It's going to be reducing in value at 140,000 naira until it has no value anymore. So, and they've told you that it has 5 years. It's going to last for 5 years. So this is the yearly depreciation. What do you then do? You can just draw a table. They've told you that it will last for 5 years. The years, you write the number of years, 1, 2, 3, 4, and 5, because it's going to last for 5 years. And then the cost, they're giving you the cost. How much do? So you repeat the cost. 750,000, the same thing, the same thing, the same thing, the same thing. And then you have the yearly depreciation. Of course, you've calculated the yearly depreciation. This is depreciation. So you've calculated the yearly depreciation as 140,000. So 140,000. You repeat it. That's your yearly depreciation. So accumulated depreciation is the next thing. Accumulated depreciation. So if this is 140, all you just need to do is to find the cumulative. If this is 140, this is 140. So 140 plus 140 will be 280. 280 plus 140, it will give you 420. 420 plus 140, that's 560. And 560 plus 140 should give you 700,000. So this is your accumulation. So every year, this is the depreciation that has accumulated. You see? So at the 5th year, the depreciation has already matched up with this, with the cost. So the 50,000 naira difference will be what you are going to sell it, which is the scrap value of 50,000 naira, the residual value. So every year you are reducing it by 140,000. So it is increasing. So it's increased to, at the 5th year, it must have reduced in value to 50,000 naira. So you sell off that item at 50,000 naira. In your books, the plant machinery will have a value of 50,000 naira. So the 50,000 naira, if you now wish to sell, will be sold at a scrap of 50,000 naira in your books. So the last thing you have to show is the net book value. The net book value, NBV. It can also be called the carrying amount, the NBV, or the carrying amount. So it's just showing the difference in this and this per year. the difference in your costs and the accumulated depreciation every year. So if you have 750,000 minus 140,000, that is 610,000. So I will do this to show that we are working in thousand. 610,000. So let me use the naira, and the naira. So this is to show that we are working in thousand because of space. So the next one is 750,000 minus 280,000. We have 470,000. That is your net book value as at the second year. So if you also have 750,000 minus 420,000 for the third year, you have 330,000. That is your net book value. That is the value of the asset as at the third year is 330,000 naira. So for the fourth year, you do the same thing. 750,000 minus the accumulated depreciation of 560, you have 190. So this asset has a value of 190,000 as at the fourth year. That's what we are saying. Then 750 minus 700,000, that is 50,000. That is your net book value as at the last year of the asset. So which is also your residual value, your scrap value. So you can write this as residual value or scrap value, whichever you want to write. Scrap value. So that is that about 2022-2023 past questions. So for example purpose, if you have depreciation this and you are asked to use the straight line method, you can simply just use this table, write your years, the cost, repeat your cost, repeat the accumulate after calculating your depreciation, yearly depreciation. Then your accumulated depreciation can be just the cumulative 140 plus this plus this will give you this plus this give, and like that. That is how you get. Then your net book value will be your cost minus your accumulated depreciation yearly. It gives you your net book value. So that is that about question 6, and that is that about the question 2020-2023 principles of accounting. Thank you very much. Please subscribe and also make sure you share with your friends.